The dual mandate could be in double trouble, folks. The Federal Reserve now, remember, they're responsible for full employment and a stable economy. By the way, the only central bank in the world with that mandate. Powell and company, of course, embarked on a very aggressive rate hiking mission. They wanted to arrest runaway inflation, right? Inflation we hadn't seen in 40 years, even if it meant triggering significant job losses. Well, large job losses, of course, would have been necessary to help quell spending. Since then, the rate of inflation has slowed, and the Fed is shifting back to supporting the jobs market. At least that's what we're hearing, which now, I guess it's more, they assume that this 2% inflation is in the bag, that they'll drift to that. But there are signs that the Fed is losing control on both sides of their marching orders, folks. Let's begin with inflation. Commodity prices. This is your commodity index. Right here, you can see we're technically have formed a double bottom, which is always sort of a signal that it may go higher, but it is starting to go higher. It broke through the 250-day moving average. I'm looking at this number, 625 here. We get through there, I think we could actually be in huge trouble. That's just one side on the inflation side. Here's something else. CPI trends, don't look now, but estimates are moving in the wrong direction. You've got forecasters who are now 2.9. This has gone up a lot. And the market itself is even higher at 3.2. So, I mean, inflation's supposed to be coming down as measured by the CPI and PCE. It's going in the exact opposite direction, according to the experts and according to the markets. And why this is important? Well, CPI has been coming in hot anyway. Check this out. 5 in the last 7 times, CPI came in higher than expected. It only came lower once. Of course, every single time it was explained away. You know, like it gets cold in the winter. I'm not sure they can explain it away if it continues to happen this way. Oh, also, one other thing. This is our friend Daniel DiMartino Booth turning us on to this. Trueflation, this is aggregate U.S. inflation. The rate of inflation, so we can see it was coming down. Back in September, we started to drift. Then all of a sudden it took off. Remember January? Cold in January? Don't worry about it. It'll go back down. It's actually getting hotter. Aggregate inflation is really going back through the roof. The other side of this thing, the employment part of it, the strong labor market, not if you really look deep. Unemployment right now, 20 states have triggered the SOM rule, right? Remember, that's a highly reliable recession gauge. You can see it's starting to spread. So while there's all kinds of contradictions out there, there's all kinds of conflicts out there, one thing that's really starting to happen here is a lot of folks out in the streets see the GDP actually moving higher, right? This is the shift. We went from here where there was going to be a soft landing to right now where there's going to be a no landing. And I got to tell you, my next guest, it was sort of like Gary Cooper in High Noon, all by himself in a no landing camp back in August. In fact, take a listen.
My thinking is we're probably going to have more of, a no landing, if you want to stick with the airplane metaphor, that the economy just keeps going, right. And it just keeps going, and that puts heat on inflation.
All right, joining me now, Bianco Research President Jim Bianco. Jim, I got to give you props, my man. Right here, when everybody was convinced there was going to be a soft landing, you say no landing. And of course, now the interesting thing is everyone is on the bandwagon with you. I don't know if that makes you feel good or not, but here's the thing. Apparently, everyone's saying de facto, the Fed's okay with a new de facto inflation rate, maybe 2.5%, 3%. Here's the thing. Even if that's the case, they keep telling the public they're going to cut. So something feels wrong here.
Yeah, no, I agree that something is a little bit amiss. If the Fed wants to up its inflation targets and say, look, we're in a no landing scenario, but a little bit more inflation is going to be better, ultimately, that's not going to be good for the bond market. Ultimately, that is going to lead to stable or higher interest rates as we go forward. And that's what everybody really wants, is they want interest rates to come down. But if you're going to tolerate higher inflation, you're going to, in an era of a no landing kind of, the economy just keeps going growth,
right?
Then interest rates are going to be your problem as you move forward.
What's the main driver of this no landing scenario? I know a lot of fiscal money still coming in, a lot of fiscal spending coming in, but it feels like the stimmies are now gone. Wages are up, but not that much. Where is this no landing scenario coming from?
Every recession, every financial crisis, something changes. In the last downturn, the COVID lockdown, we mailed people thousands of dollars. Coming out of that, they decided that they're going to spend more money. They're just going to flat out spend more money. They're going to enjoy themselves. They're going to buy things. They're going to do experiences. But what about the next downturn? What about retirement? Oh, I'll worry about that later. The next downturn, I expect the government to send me more money. They might not be wrong on that. And that's why we're seeing such huge spending And it's the federal government that's doing the same thing, too, with the huge budget deficit. If you spend money and spend money, you're not going to have a slowdown. And if you spend money, you're going to have sticky inflation, too.
I want to talk about this so-called neutral rate, because the debate is starting to grow out there. Now, I've read some smart folks saying north of 4%, others saying as low as 1.5%. Help us out here. Two things, if you can. First, what is it for the audience, and why is it so important?
So the neutral rate is not something that is observable. It's a guesstimate. Where is the interest rate that either stimulates or restrains the economy? Neutral. The Federal Reserve believes it's around 2.5% on the funds rate. They're at 5.25 to 5.5, so about 300 basis points or 3 full percent above that. So the Fed keeps talking about cutting rates because they think they've got a long way to go. Market participants, and put me in this camp too, think, no, it might be closer to 3.5 or 4. Now, why does that matter? Because if the Fed wants to start aggressively cutting rates, they're going to quickly get to stimulus. And if they get the stimulus, they're going to push the economy even faster, and they're going to push more inflation when they don't think they're doing that. So that's why that debate matters. The Fed's at that 2.5% number. That, I think, explains why Jay Powell keeps insisting that he wants to keep cutting rates, because he thinks he's got a long way to go. But the market isn't so sure that he has as far to go as he thinks.
And you're not so sure as well, right?
Yeah, no, I'm not either. I still think it's probably closer to 4%. And that's why these high rates that everybody talks about hasn't restrained the economy. I've heard a lot of people over the last several months say the market can't, or the economy can't handle these high rates. Yes, it can, because they're not as far away from the neutral rate as people think.
Wow. Good stuff, Jim. We always learn from you. And again, congratulations. I'm telling you, you put something out there that was completely against the grain. You stuck to your guns, and now everyone's joining your camp. Thanks a lot. We'll talk to you again real soon. All right, folks, my next guest